Most beginners in the UK step into Forex trading with dreams of financial freedom. They see ads, hear stories of overnight profits, and believe trading is the shortcut to wealth. But here's the harsh truth: more than 70–80% of beginners blow their accounts within the first 6 months. Today, I'll break down exactly why this happens and how you can avoid becoming another statistic. Point 1T. Unrealistic expectations. When most beginners in the UK first step into Forex trading, they don't come with the mindset of a professional. They come with a dream of making quick money, of replacing their 9 to 5 within months, of turning 500 into 400,000 in a matter of weeks. And where do these expectations come from? They don't come from reality. They come from marketing, from social media, and from the stories people spread about Forex being the easiest money in the world. If you go on Instagram, TikTok, or YouTube, you'll see people who claim to be Forex millionaires. They sit in Lamborghinis, show off expensive watches, and flash screenshots of profits. They tell beginners, you can do this too. Just follow me, buy my course, or join my Signal group. The beginner looks at this and thinks, if they can do it, why not me? So, without learning the fundamentals, without developing a strategy, and without practicing on demo accounts, they rush to fund their first live account with whatever savings they can afford. Or worse, money they cannot afford to lose. The problem with these expectations is that they create pressure from day one. A beginner doesn't enter the market to learn, to test, or to understand. They enter the market already demanding profits. Instead of thinking long-term, like how doctors spend years training, or how lawyers spend years in study, they believe trading will be different. They think 1 month of YouTube tutorials is enough. They think the market owes them money, and that mindset is toxic because the market does not reward impatience, it punishes it. Here's the harsh truth: Forex is not a get-rich-quick scheme. It is a high-risk financial market where over 70% of retail traders lose money. In the UK, where regulations are strict and brokers are overseen by the Financial Conduct Authority, (FCA), the statistics are clear: most accounts go to zero within 6 months. And it's not because the market is unfair or the broker is cheating. It's because the trader comes with unrealistic expectations, trades recklessly, and refuses to treat trading like a serious business. Think about this: if you start a traditional business in the UK, say a coffee shop, you expect it will take years before you see real profits. You invest in equipment, staff, marketing, and you know you'll make mistakes along the way. No serious entrepreneur thinks, I'll open a cafe today and I'll be a millionaire next month. But that's exactly how beginners approach Forex. They open a trading account today, and they expect to double it tomorrow. When expectations are unrealistic, every decision becomes irrational. Beginners overtrade because they want fast results. They use huge lot sizes because they want to make it big. They refuse to accept small profits because they feel it's not enough. They hold losing trades far too long because they believe the market will turn in their favor. And when the account blows up, they blame the broker, the market, or bad luck, when in reality, the root cause was their own expectations. Another layer to this problem is comparison. A UK beginner sees traders in the US or Dubai showing massive profits, forgetting that those traders may have been in the game for years, or maybe trading with accounts 100 times bigger. Comparing a fee 500 beginner account to a 50,000 professional account is like comparing Sunday League football to the Premier League. It doesn't make sense. Yet beginners compare. They get jealous, and they take bigger risks just to catch up. The solution is simple, but not easy. Beginners must reset their expectations. Instead of asking, how much money can I make? They should ask, how much can I learn before I lose money? The first goal should not be to get rich. It should be to survive, to protect capital, to gain experience, to learn risk management and discipline. Only after years of consistent practice does trading become profitable. In summary, unrealistic expectations are the #1 reason beginners in the UK blow their accounts. They think Forex is fast money, when in truth it's slow growth. They think they can skip the learning phase, when in truth it's unavoidable. Until they respect the process, they will remain victims of their own dreams, and the market will take every pound they bring to the table. Point. Over-leveraging. One of the deadliest traps for beginners in the UK Forex market is over-leveraging. This is where most accounts don't just shrink slowly, they get destroyed overnight. And it happens because beginners misunderstand what leverage really is. In the UK, the Financial Conduct Authority (FCA) has capped leverage for retail traders at 130. That means for every 1 in your account, you can control 30 in the market. So, if you deposit 100, you can open a position worth 3,000. At first glance, this feels exciting. Beginners see it as an opportunity to make big profits quickly. Why risk 100 to make fee 5 when I can risk it to make 200s? That's the mindset. But what they fail to realize is that leverage is a double-edged sword. It amplifies profits, yes, but it also amplifies losses. Let's use an example. Imagine a beginner in London with a 500 account. They decide to trade GBP USD with maximum leverage. They open a position worth 15,000. A tiny move of just 1% against them equals a 250 loss. That's 30% of their entire account gone in minutes. A 2-3% move, the account is blown. The irony is, they thought leverage was their friend, but in truth, it was a ticking time bomb. Now, professional traders also use leverage. But here's the key difference. They use it responsibly. They never risk their entire account on one trade. They size positions so that even if the trade goes against them, it's just a small dent, not total destruction. Beginners, on the other hand, use leverage recklessly, as if they are trying to win the lottery. And this lottery ticket mentality is exactly what kills them. Another reason UK beginners over-leverage is greed fueled by social media. They see screenshots of traders making 1,000 in a day from tiny accounts. They don't realize those traders are risking insane amounts, sometimes their entire balance, on one position. Most of those trades never get shown publicly because when they lose, no one brags about it. But the beginner copies that behavior, hoping to get rich fast. Instead of focusing on protecting capital, they go all in. And when the market makes its natural pullback, the account vanishes. There's also the emotional roller coaster caused by leverage. Imagine turning 200 into flee 600 in just a week. The beginner feels unstoppable. Confidence skyrockets. They increase lot size even more. But the very next week, the market moves against them, and in one trade, they lose it all. That emotional crash, going from hero to zero, is devastating. Many beginners quit Forex altogether after this happens. Not because the market is impossible, but because they never learned to control leverage. Let's also touch on psychological damage. When a beginner over-leverages and blows an account, they don't just lose money, they lose trust in themselves. They begin doubting whether trading even works. Some chase losses by depositing more, falling into a cycle of desperation. Others quit too early, never realizing that their mistake wasn't Forex doesn't work. It was their misuse of leverage. The solution here is discipline. Beginners must flip their mindset. Leverage is not a shortcut to wealth. It's a tool for capital efficiency. Professionals might use leverage to manage large portfolios without tying up all their money in one place. But they never use it as a weapon for gambling. A smart UK trader risks only 1-2% of their account per trade. On a FA 1000 account, that means risking 10 to 20, not 200. By sizing trades properly, they ensure they can survive losing streaks without wiping out their capital. It's also important for beginners to realize that making small, consistent gains compounds over time. Turning 500 into 600 over a month by trading smart is far more valuable than turning 500 into a 2,000 in a week only to lose it all the next. Survival is the real game, and the only way to survive is to respect leverage, not abuse it. In conclusion, over-leveraging is the silent killer of UK beginner accounts. It seduces traders with the promise of quick profits, but it punishes them with devastating losses. Until beginners understand that leverage is not a magic key, but a dangerous blade, they will continue to blow accounts. The harsh truth is this: leverage doesn't care whether you're a beginner or a professional. It only magnifies your discipline or magnifies your recklessness. If you use it wisely, it helps you. If you abuse it, it buries you. Point 3. No risk management. If over-leveraging is the bullet that destroys most beginner accounts, then lack of risk management is the trigger that pulls it. And in the UK Forex trading scene, this is the single most common reason why new traders watch their accounts vanish so quickly. Ask any beginner, "What's your risk per trade?" 9 times out of 10, you'll get silence. They don't have an answer because they never thought about it. Most beginners approach Forex like a guessing game. They see a candlestick pattern, or they follow a telegram signal, and they hit buy or sell without calculating the consequences. They're only thinking about how much money they can make, not how much money they could lose. This is dangerous. Why? Because risk management isn't a side detail in trading. It's the very foundation. Without it, even the best strategy will eventually collapse. You can have perfect technical analysis, you can predict market direction 70% of the time, but if you don't manage risk, one bad trade can wipe out months of progress. Let's put this into numbers. Imagine a UK beginner with a 1,000 account. They decide to risk 200 on a single trade because they believe strongly in the setup. That's 20% of their entire account in one shot. If the trade works, great, they might double their money. But if it fails, they've dug themselves into a massive hole. To recover from a 20% loss, they need a 25% gain just to break even. If they repeat this mistake 2 or 3 times, the account is gone. Now compare that with a professional mindset. A disciplined trader risks only 1-2% of their account per trade. On a 1,000 account, that means risking V10 at 20. Boring, maybe. Slow, definitely. But here's the key. By managing risk, they give themselves time. Time to survive losing streaks, time to learn from mistakes, and time to allow probabilities to work in their favor. This is why professionals stay in the game while beginners crash out. Another issue is that many beginners in the UK don't use stop-loss orders, or worse, they use them but keep moving them. They enter a trade, set a stop, and when the market starts moving against them, they shift the stop further and further away. It'll come back, they tell themselves. But the market doesn't care about their hopes. By refusing to take small, controlled losses, they allow one trade to grow into a disaster. And then there's the opposite problem. Traders who don't let their winners run. They close trades too early because they fear losing the little profit they've made. This creates a deadly imbalance of small wins and massive losses. Over time, the math guarantees account failure. What makes this worse for UK beginners is the constant temptation from social media. Influencers post flashy results, showing 110 or 120 risk to reward trades. Beginners think that's the norm, so they ignore realistic targets. They risk huge amounts chasing unrealistic rewards, and when those trades fail, they lose motivation and money. Here's the brutal truth: without risk management, you're not trading, you're gambling. And the house always wins. Risk management is about treating trading like a business. No serious business bets everything on one deal. They diversify, they protect capital, and they play the long game. Traders must do the same. The solution starts with a simple rule: never risk more than 1-2% of your account on a single trade. If your account is a 500, risk 510. If it's 2,000, risk 20-40. At first, these numbers seem too small to be worth it. But here's the secret: the goal isn't to win big, it's to not lose big. Once you protect your capital, profits can grow slowly through compounding. Also, always use stop-loss orders and respect them. A stop-loss isn't just a tool to limit losses, it's a psychological shield. It forces you to accept when you're wrong, cut the trade, and move on. No single trade should ever have the power to ruin your entire account. In conclusion, the harsh truth is this: most UK beginners blow their accounts not because their strategies are bad, but because they refuse to manage risk. They trade too big, they ignore stops, they chase unrealistic profits, and they let emotions dictate decisions. The difference between gamblers and traders is risk management. Until beginners learn this, they will always feed the statistics of failure. But once they master it, they give themselves the most powerful advantage in trading survival. Point 40. Trading without a plan. One of the harshest truths about beginner traders in the UK is this: most of them don't even have a plan. They dive into the Forex market armed with excitement, hope, and maybe a handful of strategies they copied from YouTube or Telegram groups. But no real structure, no roadmap, and no consistency. And when there's no plan, failure isn't just likely, it's guaranteed. Think about it. Would you step onto a football pitch with no game strategy, no formation, and no idea who's playing what role? Of course not. Even the weakest teams in the Premier League come prepared with a plan. Yet beginners in Forex walk into one of the toughest financial arenas in the world, the $6 trillion a day global currency market, completely unprepared, and the market punishes that lack of preparation every single time. The problem with strategy hopping. Beginners often jump from one method to another. One week, they're scalping GBP/USD at the London Open because they read online that London is the best time to trade. The next week, they're swing trading EUR/GBP because someone on YouTube said it's safer. The week after, they're trying gold, indices, or even crypto. They never give one strategy enough time to test, refine, and master. Instead, they keep searching for the perfect system. But here's the truth: no system is perfect. Every method has losing trades. The real key is consistency, sticking to one edge and executing it over time. Without a plan, beginners never reach that stage. Copy-paste trading. Another dangerous habit is copying trades from signals groups. In the UK, Telegram and WhatsApp are flooded with so-called mentors who sell signals for $30 a month. Beginners think, this is easier than learning. I'll just follow. But copying signals is not a plan, it's dependency. What happens when the group disappears? What happens when the trader sending signals has a bad week? Without their own plan, beginners are lost. Worse, they never learn how to make independent decisions. No written rules. A proper trading plan is not just in your head, it's written down. It includes entry criteria, exit criteria, risk management, and even psychological rules. For example, only trade GBP/USD and EUR/GBP. Only enter when the 4-hour trend matches the 15-minute confirmation. Risk only 1% per trade. Walk away after 3 trades a day, win or lose. These rules may sound boring, but they are what separates professionals from amateurs. Beginners skip this step entirely. They rely on gut feelings, emotions, or impulsive reactions to the market. That's not trading, that's gambling. The danger of random trading. Without a plan, trading becomes random. One day, a beginner risks 5 on a trade. The next day, 100. One day, they close a trade after 10 pips. The next day, they let it run for 200. There's no consistency, which means there's no way to measure progress. Imagine trying to get fit by going to the gym with no program, lifting random weights, eating random meals. You might see small results here and there, but you'll never build real strength. Forex is the same. Without structure, results are random and unsustainable. How a plan saves beginners. A plan isn't just about strategy, it's about discipline. It acts like a shield against emotions. When you're tempted to revenge trade after a loss, your plan says, stop. When you feel greedy after a win, your plan reminds you to stick to your rules. In the UK market, where volatility can spike during Bank of England announcements or unexpected Brexit-related news, having a plan keeps you grounded. Instead of panicking, you know exactly when to trade and when to stay out. The long-term edge. The reality is that professional traders aren't always right. In fact, many successful traders win only 50–60% of the time. What makes them profitable is that they follow their plan consistently, allowing their winners to outgrow their losers. Beginners without a plan quit too early because they can't see progress. Professionals stick to their process, and over time, probability works in their favor. Conclusion. In the end, the harsh truth is this: trading without a plan is like setting sail in the middle of the Atlantic with no map, no compass, and no destination. You might get lucky for a while, but eventually the waves will sink your boat. UK beginners blow their accounts not because Forex is impossible, but because they refuse to treat it like a structured business. The solution is simple, though not easy. Write down a trading plan, test it, stick to it, and refine it over time. Only then will you shift from gambling to trading. Only then will you stop blowing accounts and start building consistency. Point 5v. Emotional trading. If there's one silent killer that destroys UK beginner accounts faster than anything else, it's emotional trading. You can have a solid strategy, decent risk management, and even a written plan. But the moment emotions take over, all logic disappears. And in Forex, when logic disappears, so does your account. Fear and greed, the two monsters every new trader quickly meets the same two enemies, fear and greed. Fear makes you hesitate when it's time to act. You see a perfect setup, but instead of entering, you freeze, worried the market will turn against you. Or worse, you enter and then close the trade too early, grabbing a tiny profit because you're scared to lose it. Greed, on the other hand, makes you reckless. After a win, you feel unstoppable. You increase your lot size, open more trades, and push your luck, until the market humbles you with a devastating loss. Both emotions drive impulsive decisions. And impulsive decisions are the opposite of trading. A trader who reacts emotionally is not following a plan, not respecting probabilities, and not thinking long-term. They're gambling with their account balance, and the odds are stacked against them. Revenge trading. One of the most dangerous emotional traps beginners fall into is revenge trading. Let's say a beginner in London loses a 50 on a trade. Instead of walking away, they feel an overwhelming urge to win it back immediately. They jump into another trade without analysis, often with a larger lot size. That trade loses too. Now they're down 150. The spiral continues until the account is drained. Revenge trading doesn't come from strategy. It comes from ego. The market doesn't care about your feelings, but beginners act as if they can get back at the market. The market always wins. Overconfidence after wins. The opposite side of revenge trading is overconfidence. A beginner has a lucky streak, 2 or 3 wins in a row. Suddenly, they feel like a genius. They think they've cracked the code. This false confidence leads them to break their own rules, risking more per trade, ignoring stop losses, or trading during high-impact news without preparation. And just like that, one bad trade wipes out all their progress. In the UK, where GBP pairs can swing violently during Bank of England announcements, overconfidence is a direct path to blown accounts. The emotional roller coaster Forex is stressful, especially for beginners. Watching candles move up and down can trigger anxiety, excitement, and frustration all in the span of minutes. Without emotional control, beginners ride this roller coaster until they burn out. They lose sleep, they make impulsive trades at midnight, they check their phones every 5 minutes. Trading consumes them, not as a business, but as an obsession. This leads to burnout, poor decisions, and ultimately failure. How professionals manage emotions. The difference between beginners and professionals isn't that professionals don't feel emotions. It's that they manage them. Professionals trust their plan. They enter a trade, set their stop, loss, and take profit, and then walk away. They accept that not every trade will win. They understand probabilities and don't attach their self-worth to a single outcome. One common technique professionals use is journaling. They write down their trades, their emotions before and after, and their reasons for entering. Over time, they see patterns. Maybe they realize they take bad trades after losing streaks, or they overtrade when they're tired. By becoming aware of these emotional triggers, they learn to control them. Another technique is risk control. When you only risk 1% of your account per trade, losses sting less. It's easier to stay calm when you know a losing trade won't ruin your account. Beginners who risk 20–30% per trade can't stay calm because every trade feels like life or death. Building emotional discipline. Emotional discipline comes from repetition and routine. UK beginners must treat trading like going to the gym. At first, it's hard. You want to skip steps. But over time, discipline builds habits. Set strict rules, only trade at specific times like the London Open, limit trades per day, and walk away after hitting your daily loss limit. By creating structure, you reduce the chances of emotional decisions. Conclusion. The harsh truth is that emotional trading is the reason most UK beginners blow their accounts, even more than bad strategies. The market is designed to trigger emotions, fear during pullbacks, greed during rallies. Beginners who can't control these emotions are doomed to fail. But those who learn discipline, who accept losses as part of the game, who don't chase wins, and who stick to their rules, give themselves a fighting chance. In Forex, emotions are the enemy. Master your emotions and you master the market. Fail to control them, and the market will take every pound you own. Point 60. Ignoring fundamentals. Another brutal reason why UK beginners blow their accounts is that they ignore fundamentals. They stare at charts, memorize candlestick patterns, and worship technical indicators, but they completely forget the fact that currencies are driven by real world events, economic data, and central bank policies. And in the UK, fundamentals are especially powerful because the British pound is one of the most traded and most volatile currencies in the world. The illusion of pure technical trading. Most UK beginners believe they can succeed with only technical analysis. They download MetaTrader 4 or 5, add moving averages, RSI, MACD, and think they've unlocked the secret code of the market. They tell themselves, the charts contain everything I need. But here's the harsh truth. Charts can't warn you when the Bank of England is about to announce an interest rate hike. They can't prepare you for a shock inflation report or unexpected unemployment numbers. Fundamentals move markets in ways that no indicator can predict, and ignoring them is like driving blindfolded down the motorway. The Bank of England factor. In the UK, the single biggest driver of GBP volatility is the Bank of England BOE. Every time the BOE makes an interest rate decision, the pound reacts violently. Even if the decision is expected, the governor's press conference or the vote split among policymakers can send GBP USD swinging by hundreds of pips in minutes. Beginners who enter trades without knowing the BOE calendar get wiped out instantly. Imagine holding a leveraged position just before a surprise rate cut. It's financial suicide. Professionals know this, so they either stay out of the market or position themselves strategically. Beginners ignore it, and their accounts vanish. Economic reports that beginners ignore. Apart from central bank decisions, there are monthly and weekly economic reports that shape the pound. CPI is a consumer price index. True inflation data. Inflation determines the BOE's next move. If inflation is too high, rate hikes are likely, which strengthens GBP. If it's low, cuts are possible, which weakens GBP. GDP, gross domestic product. A weak GDP print signals economic slowdown, putting pressure on the pound. Unemployment and wage data. Strong jobs and rising wages increase inflation risks, while weak numbers suggest economic weakness. PMI's Purchasing Managers Index, a leading indicator of economic health that often surprises the market. Beginners in the UK often don't even know when these reports are released. They jump into trades without checking the economic calendar. Then, when volatility explodes, they wonder why the market turned against them. The truth is, the market didn't turn, it reacted exactly as expected to the data. Global spillovers that hit the UK economy doesn't exist in isolation. Global events spill over and shake GBP pairs constantly. For example, a US Federal Reserve rate cut can weaken the dollar, sending GBP USD higher, even if nothing happened in the UK. European Union decisions or crises impact GBP EUR given the UK's close trade ties. Political events like Brexit negotiations, snap elections, or government instability can cause massive GBP swings overnight. Beginners who ignore these global fundamentals are blindsided. They might be staring at a clean technical setup, but the moment news hits the wires, the chart becomes chaos. Why beginners avoid fundamentals? Many UK beginners avoid fundamentals because they seem complicated. Reading central bank statements, analyzing inflation reports, or understanding macroeconomics feels overwhelming compared to drawing lines on a chart. But this avoidance comes at a high cost. Fundamentals don't care if you understand them or not. They move the market regardless. Blending fundamentals and technicals. The smartest approach is blending fundamentals with technicals. Use fundamentals to know when the market is likely to be volatile, and use technicals to decide how to trade it. For example, if you know the BOE is likely to raise rates, you expect GBP strength. Then, you look for a technical setup that aligns with that bias. This combination gives traders the edge. Conclusion: the harsh truth is this: Ignoring fundamentals is one of the fastest ways UK beginners blow their accounts. They treat Forex like a video game, relying only on indicators, while the real drivers of the pound are unfolding in the news. Until beginners respect the power of the Bank of England, economic reports, and global spillovers, they'll keep getting blindsided by volatility. Trading without fundamentals is like trying to predict the weather by only looking at yesterday's clouds. Professionals study the forecast, beginners ignore it, and they pay the price.